Silver just smashed past $91, all-time record. And I need you to understand something right now, because what's happening isn't just a price spike. This is a system coming apart at the seams while everyone with power tries to convince you everything's fine. They're telling you it's normal market volatility. They're saying supply will adjust. They're claiming this is temporary. They're lying. And I'm going to prove it to you. Let me show you what really happened this week, and why it matters more than any financial event you've seen in years. On January 11th, just 3 days ago, the Department of Justice subpoenaed the Federal Reserve, not for some technical violation buried in regulations. They're threatening criminal charges against Jerome Powell, the Fed chairman himself, the man who controls interest rates for the world's reserve currency. The official reason they're giving: building renovation cost overruns at Fed headquarters. Does that sound right to you? Building expenses, construction overruns. That's what they're using to threaten the most powerful central banker on the planet with criminal prosecution. Because it's not. This is a pretext. This is naked political pressure designed to break Fed independence, to install someone who'll do what they're told when it comes to interest rates and money printing, someone who won't resist when the pressure comes to keep rates low, while the government runs multi-trillion-dollar deficits, someone who'll monetize the debt without asking uncomfortable questions about inflation or currency destruction. And the moment that news hit, the dollar dropped, gold spiked, and silver absolutely exploded higher, punching through resistance levels like they were made of paper. Because the market knows exactly what this means. When the Justice Department weaponizes criminal investigations against the Federal Reserve Chairman, you're not watching normal politics. You're watching the destruction of the institutional firewall between political power and monetary policy. When central banks lose independence, when monetary policy becomes political theater, your currency gets destroyed. It's not theory. It's not some abstract economic concept debated in universities. It's mathematical certainty, written in the ruins of every fiat currency that's ever existed. The Roman denarius, the Weimar Papimark, the Zimbabwean dollar, every single one died the same way: political control of money creation. And smart money is running for the exits right now, piling into physical metal because they understand the endgame. Silver was trading around $28 in January last year. 12 months ago, this morning it's above 91. That's nearly 200% in 12 months, and I want you to think about that for a second. A 200% move in a globally traded industrial commodity with a relatively stable mine supply. That doesn't happen because of normal supply and demand adjustments. That happens when something fundamental breaks in the pricing mechanism. When the gap between paper price and physical reality becomes impossible to hide anymore. But here's what most people are missing. What the financial media isn't telling you. What your broker probably doesn't understand himself. This isn't just about price going up. It's about a fracture forming in the market itself. A split between paper promises and physical reality. Between the silver that exists on exchange floors and computer screens versus the silver that actually exists in bars and coins you can hold in your hand. And that fracture is about to become a canyon. Let me explain exactly what I mean. Because this is where theory meets concrete shortages you can't talk your way out of. On January 1st, 2 weeks ago, China implemented new export licensing controls on silver. Now, let's be clear about what this actually means. China doesn't mine all the world's silver, not even close. But they control a massive chunk of global refining and export infrastructure. Raw silver ore from mines around the world gets shipped to China for processing. It gets refined into pure bars. Those bars get shipped globally to mints, manufacturers, everyone who needs physical metal. And starting this year, only 44 companies have government approval to export silver for the next 2 years. 44 approved exporters, down from hundreds, maybe thousands when you count smaller operations. And every shipment needs a license. That's not a free market operating on price signals. That's a choke point. That's China telling the rest of the world, we're going to decide how much silver leaves our borders. When it leaves, who gets it, and at what price? And there's nothing you can do about it because we control the refining infrastructure you've depended on for decades while you offshored your industrial capacity. What did everyone in Washington say when this was announced? They called it concerning. They warned about supply chain disruptions. Then they went right back to business as usual, pretending supply would magically adjust, pretending other refiners would pick up the slack, pretending this was negotiating posture for trade deals. The market called their bluff immediately. Within days of China's restrictions taking effect, Something happened that should have been front-page news everywhere. Spot silver. The price for immediate delivery right now today started trading higher than silver futures contracts, delivery months from now. That's called backwardation. And in commodity markets, it's a flashing red emergency signal that screams physical shortage. Think about what backwardation means. Normally, futures prices are higher than spot because you have to account for storage costs, insurance, the time value of money. It costs something to hold physical metal for 6 months, so the futures price reflects that. But when spot trades above futures, it means people are so desperate for metal right now, this instant, that they're willing to pay more for immediate delivery than for a promise of delivery later. It means the fear of not having physical metal today outweighs everything else. Every normal market relationship inverts. When you see backwardation in oil, it means refineries are running dry and gas stations might not have fuel next week. When you see it in wheat, it means bakers can't get flour and food prices are about to spike. When you see it in silver, it means industrial users who need it for solar panels and electronics, plus investors who want physical bars, are all scrambling for the same shrinking pool of available metal. And they're finding out that metal isn't where they thought it was. Here's the other side of that equation, the part that should absolutely terrify anyone holding paper silver positions: COMEX silver deliveries. These are people who bought futures contracts and instead of rolling them over into the next month, or settling in cash like most traders do, they said deliver me the actual metal, and the exchange has to provide it. Has to. That's how the contract works. In January alone, over 8 million ounces stood for delivery. That's physical metal being pulled out of exchange warehouses, loaded onto trucks, shipped to whoever demanded it. Now, 8 million ounces might not sound massive, but put it in context. Registered silver at COMEX, the metal that's actually available for delivery against contracts, has been draining for months. Every time someone stands for delivery, that's metal leaving the system permanently. Unlike gold, where wealthy buyers are often comfortable with allocated storage and paper claims, silver buyers increasingly want the real thing in their physical possession. Because silver's affordable enough per ounce that you can take delivery without needing a vault and armed guards. And here's what should make your hair stand on end if you understand what it means. The cost to lease physical silver, to borrow it if you're a bank or fund that sold silver you don't actually own, just spiked to 39% annualized. The normal rate, the rate that prevailed for years when everything was functioning smoothly, is less than 1%. Essentially zero, a rounding error. Now it's 39%. If you're a bank that sold silver short, meaning you sold silver you don't have sitting in your vault, you're now paying 39% annual interest to borrow real metal to cover your position. That's not a market functioning normally. That's institutions realizing they made promises they can't keep, scrambling desperately to find physical metal before they're forced to default. When lease rates spike like that, it's because the people who actually own physical metal are refusing to lend it out at normal rates. They're saying, I'm not confident I'm getting this metal back, so if you want to borrow mine, you're paying rates that compensate for that risk. Or they're saying, I think this metal's about to be worth a lot more, so the only way I'm parting with it temporarily is if you pay me rates that reflect what I'm giving up. Either way, it's a sign that physical silver is being hoarded, pulled off the market, held tight by people who understand what's coming. And it gets worse, because this isn't a one-year blip. This is the 5th consecutive year the silver market is running a structural deficit, meaning global demand exceeds mine supply. Year after year after year, for 5 straight years, the world has consumed more silver than miners pulled out of the ground. Where's the extra silver coming from? Above-ground inventories, existing stockpiles, metal sitting in vaults and ETFs and government reserves slowly getting drawn down. You can drain inventories for a year or two, and the market barely notices. But 5 years? At some point, you've run out of buffer. At some point, the inventories are gone and there's no more slack. And when that happens, price has to adjust violently higher to destroy enough demand that supply and demand rebalance. We're approaching that point. Maybe we're already there. And here's what makes this different from past silver rallies. Industrial demand isn't discretionary anymore. 20 years ago, if silver got expensive, manufacturers could redesign products to use less, find substitutes. But today, silver's embedded in technologies critical to the energy transition. Solar panels need silver for conductivity. Each panel uses roughly 1 ounce, And global solar installations are exploding as governments mandate renewable energy. Electric vehicles use significantly more silver than traditional cars because of electronics, sensors, battery management systems, 5G networks, medical devices. They all use silver in ways that can't be easily substituted without degrading performance. So when silver price climbs, industrial users don't stop buying. They pay up, because the alternative is shutting down production or falling behind competitors. Industrial demand is relatively inelastic, which means all the price adjustment has to come from investment selling. And if investors aren't selling because they think silver's going higher, and if jewelry demand holds because silver's still affordable compared to gold, then price has to go dramatically higher before enough demand destruction happens to rebalance the market. That's the setup. Structural deficit. Industrial demand that can't stop. Investment demand accelerating because of the Fed crisis and China restrictions. Inventories draining. Lease rates screaming, shortage. And backwardation telling you the physical metal isn't where the paper market says it is. Now let's talk about the split that really determines who wins and who loses in all this. The divide between paper silver and physical silver. If you go to a dealer right now, trying to buy physical silver coins or bars, you're paying $85 to $95 per ounce depending on product and dealer. Spot price is $91. At first glance, that seems close. But here's what you need to understand about premiums. That gap between spot and what you actually pay. 6 months ago, premiums over spot were $4 or $5. That covered minting costs, distribution, dealer margins, the overhead of getting physical metal from refinery to your doorstep, normal business. But now premiums are stretching to $10, $15, even $20 over spot. And it varies by product. Generic rounds might be lower premium. American Eagle's higher, but across the board, premiums are climbing. That's not dealer greed. Dealers aren't pocketing extra profit. Many are getting squeezed because their wholesale costs are climbing, and they can't pass all of it through without losing sales. This is supply tightness flowing through the system. Refiners running at capacity and still backlogged. Wholesalers unable to secure product. Mints that can't get enough blanks because refineries can't get enough feedstock. This is what happens when demand overwhelms physical production infrastructure, and it's going to get worse. Because unlike paper markets, where you can create infinite contracts with keystrokes, physical metal takes time to produce. You have to mine ore, smelt it, refine it to purity, cast bars or blanks, mint coins, ship through distribution networks already strained from years of underinvestment. You can't just flip a switch and double production. It takes years to open new mines. Years. We're not getting meaningful new mine supply until late this decade, at the earliest. So premiums are going to climb. And at some point, you have to ask, what exactly is spot price? If you can't buy physical metal anywhere near spot, if every dealer in every country is charging massive premiums, then spot isn't the real price. Spot is just the price people trade paper contracts at while hoping they never have to deliver physical metal. And that brings me to the flip side. If you own shares in a silver ETF or a futures contract, you're sitting on a digital entry in a database. You don't have metal, you have a claim on metal, a promise. A contract saying under normal circumstances you're entitled to the value of X ounces at current market prices. But what happens when circumstances aren't normal? When the system gets stressed? When COMEX inventories get dangerously low and the exchange decides it can't allow unlimited delivery without risking default? Those claims get settled in cash, not silver, cash at whatever the paper price says, which could be nowhere near what physical metal trades for in the real world. Think that's speculation? It's not. We already saw it in 2020. Gold and silver futures went into backwardation, paper prices crashed while physical premiums exploded, dealers ran out of inventory. Mints shut down. If you owned a futures contract, you got cash settled at the smashed paper price while physical metal traded 20, 30, 40% higher in the real world. People who owned physical metal preserved wealth. People who owned paper promises got destroyed. This isn't theory. We've seen this movie before, and I'm going to take you back 45 years so you understand exactly how this ends. 1982. Billionaire brothers from Texas, Nelson and William Hunt, started accumulating massive silver positions. Physical metal and futures contracts. They weren't trying to manipulate markets, at least not in their minds. They genuinely believed inflation was going to destroy the dollar. They saw reckless government spending, Central bank printing, currency debasement, the same thing's happening now. And they decided silver was the best hedge. So they bought and kept buying. And silver went parabolic, running from under $7 to over $50 by January 1980. More than a seven-fold increase in about 12 months. Sound familiar? The Hunts were convinced silver was going to 100. They had physical metal in vaults, futures contracts giving them rights to millions more ounces. They'd convinced Saudi investors to join them. This was the trade of the century in their minds. And they were winning. Then on January 7, 1980, COMEX changed the rules mid-game. They implemented Silver Rule 7. And this is where you need to pay very close attention. Silver Rule 7 said, you couldn't buy silver futures on margin anymore. Only liquidation orders, sell orders, were allowed. If you were long silver, if you owned contracts expecting price to keep climbing, you were suddenly prohibited from adding to your position. You couldn't buy more. You couldn't even hold if you were on margin, which most traders were. You had to sell forced liquidation. The Hunt brothers were leveraged. They'd bought physical metal with cash, and that they kept. But they'd also bought massive futures positions backed by borrowed money, credit lines from banks, happy to lend when silver was climbing. When the rule changed, lenders panicked, margin calls hit like a tsunami, banks demanded the Hunts put up more collateral or sell. When you're forced to sell in a market where everyone knows you have to sell, the price collapses. Silver crashed from $50 to under $11 in weeks. March 27, 1980. Silver Thursday. The Hunts went bankrupt. Billions evaporated. But here's the lesson everyone forgets. If you held physical silver through that entire event, you didn't get a margin call. You didn't face forced liquidation. You held an ounce before the rule change, you held an ounce after. The price dropped, sure. But you still had the metal, and within a few years, anyone who kept their physical recovered as the metal climbed back. The people destroyed were those holding paper leverage. Why am I telling you this now? Because we're watching the same pattern play out, just with different players. In 1980, it was the Hunts and COMEX changing margin rules. Today, it's the Justice Department attacking the Fed, while China restricts exports. Different tactics, same objective. Control the game, change the rules when it suits the powerful, protect the system, not individual investors. And here's what makes today worse. The Hunt brothers squeeze unfolded over 18 months. One cycle. Today we're looking at a 5-year structural deficit that can't be fixed quickly. China implementing permanent export controls, not temporary margin changes. Industrial demand locked in for decades, not speculative buying that evaporates. You can't force out solar manufacturers who need silver. You can't margin call electronics companies that must have it. This isn't a speculative bubble. This is fundamental supply crisis colliding with irreversible demand growth, happening exactly when trust in central banks collapses because of political interference. And here's what that means for you. If you're holding physical silver in your possession, you're outside that system, not subject to rule changes, not vulnerable to counterparty risk. You're holding real wealth but spend money for 5,000 years. But if you're holding paper silver, futures, unallocated positions, even some ETFs, you're holding a claim depending on a system functioning properly. And right now that system is cracking everywhere. The Fed's under political attack. China's restricting exports. COMEX inventories are draining. Lease rates indicate panic among those who sold silver they don't have. The market's been in deficit 5 straight years. Every pressure point is hitting simultaneously. That's not coincidence, that's structural breaking. Now here's where this gets personal. If you've been thinking about physical silver, watching this rally, waiting for a pullback, you need to recalibrate. The opportunity isn't timing a dip, it's securing physical metal while still available near spot. When you buy physical, you want coins or bars from recognized mints. American Eagles, Canadian Maples, government bullion, or standard bars from approved refiners. You want weight and purity stamped on universally recognized metal. For instant liquidity when you sell, avoid anything keeping you in the paper system. ETFs without physical redemption. Futures unless you understand delivery and have capital for it. Unallocated storage where your silver's pooled. All those structures keep you dependent on the system behaving rationally. We just proved it's not rational. Store metal securely. A safe, a vault, wherever you're comfortable. But you need access. If it's in a bank box, understand banks can restrict access in crises. If with third-party storage, make sure it's allocated, specific bars assigned to you, segregated. You're paying for security and independence from the banking system. And here's what nobody mentions. At $28 last January, silver was undervalued versus gold. Today at 91, it's still historically cheap relative to gold. If this monetary crisis continues, if the Fed loses independence and printing accelerates, silver has significant room to run higher. But that's not why you buy it. You buy it because it's money that can't be printed. A hard asset in a world drowning in paper debt. When governments and central banks prove they can't be trusted with currency, physical metal becomes the only vote that actually matters. The window for reasonable prices is closing. Not next year, not next quarter. Now dealers report inventory tightness, premiums climbing, wait times extending. Every passing week, as more people wake up to what's happening, demand intensifies. This isn't about predicting market tops. It's recognizing we're transitioning from a world where paper promises were trusted to where physical possession is all that counts. And silver, smaller, more accessible, more affordable than gold, is where regular people can still act. Let me be direct. If this resonates, if you've been watching silver climb wondering when to move, this is your moment. Not to speculate or trade to secure physical metal you hold outside the banking system, outside paper markets, outside the reach of rule changes and manipulation. The Hunt brothers learned the hard way what happens when you trust the system to play fair. It doesn't. Rules change when you're winning, and the only survivors are those holding physical metal in their own possession. Silver just broke $91, never been higher. And based on everything we've covered, the supply crisis, Fed under attack, China's controls, COMEX stress, this is just the beginning. The question isn't whether silver goes higher. It's whether you'll hold physical metal when it does, or be stuck in paper that settles for cash when the music stops. If you found this valuable, hit subscribe. Turn on notifications. As this develops, as we get more delivery data, premium intel, physical versus paper market updates, I'll keep breaking it down. No hype, no pitch, just facts and what they mean for your wealth. Drop a comment. Tell me what you're seeing. Physical silver available where you are, premiums climbing, dealers reporting wait times. This is a community. The more real-world intel we share, the better decisions we make. Silver broke 91 after DOJ went after the Fed. That's not random. That's cause and effect. If you understand what that means, if you're taking action now securing physical metal, you're positioning for what comes next. While everyone else is still trying to figure out what happened, stay sharp, stay informed. Remember, physical metal in your possession is worth more than any promise on paper. I'll see you in the next one.